Welcome to Motley Fool Money. Thanks for being here. I'm your host, Chris Hill. Joining me in studio this week from Motley Fool One, Jason Moser. From Motley Fool Hidden Gems, Chief Investment Officer here at the Motley Fool, Andy Cross.
Wow.
And from $1 Million Portfolio, the very impressed Ron Gross.
Ron,
Good to see you guys.
The sea games in the house, Ron.
Earnings Palooza rolls on. We've got the latest results from Visa, MasterCard, Facebook, and more. We've got one iconic brand getting a serious makeover. We will delve into that. And as always, we've got a few stocks on our radar, but we begin this week with the big macro. The latest unemployment report is out. 165,000 jobs added in April as the unemployment rate drops to 7.5%. And Ron, February and March numbers revised upwards, an additional 114,000 jobs. We got the Dow and S&P both hitting new record highs on Friday. What's not to love?
Oh, Chris. Do you want me to jump on the bandwagon or you want the truth? What are we doing here?
That's why I asked you what's not to love, because I knew you'd come back with something not to love.
Here's what I really think. I think this report is good enough to show that the recovery has installed, and that's what you're seeing in the markets. You're seeing kind of that relief because, you know, on any given month, this could go either way. We have only 2.5% economic growth right here, 7.5% on unemployment even after this. Things still aren't great. In fact, that labor force participation rate is flat. The broader measure of unemployment is actually up a little tick. So I'm happy to see we're not falling backwards, but, I mean, I'm not popping champagne corks yet.
Jason, we were talking earlier in the week, the whole the old investing adage, sell in May and go away. When you look at the reaction of the market on Friday as a result of this kind of pops that balloon a little bit, doesn't it?
Maybe a little bit, but hey, we're not Europe. So, I mean, I think a lot of what Ron said is pretty much how I feel too. I mean, there's good news in there that the unemployment rate's coming down and that the average wage is going up. Concerns about the broader unemployment U6 ticking up a little bit. There's some question there as to the quality of the jobs that are out there and whether those can really sustain a robust recovery. And I think there's a boots on the ground dynamic that we all have to recognize at some point. You just kind of look around and it doesn't seem like everything is back to just square one yet. But with that said, I think that the Fed's going to keep their foot on the gas, and that makes the stock market really one of the best places, if not the best place, to find the returns. And so I anticipate the sell in May go away adage to not be so applicable this summer.
Yeah, Andy, I mean, when you look around at all the investing options people have, for better or for worse, the U.S. stock market continues to look like the best option.
Yeah, for better, really, for better. I mean, like, you look at this number. Private payroll is up 176,000, which is up over the revised number for March, both higher than economists forecast. I mean, the U.S. economy is doing okay. I mean, like the private growth, the private GDP number is somewhere like 4%. It's the government. It's both federal, state, and local government level where we're really seeing a lot of the struggle. So the U.S. economy stocks aren't all that expensive. They've had a nice run, obviously. But when you look around the world and you look at what investors can get from bonds, really investing in stocks still remains the best way to go.
You know, we're right in the smack middle of earnings season here, and I think in general what we're seeing is kind of low revenue growth, but pretty good profit growth, and that's because companies are kind of lean and mean still, and you can see that in the unemployment rate. Companies are really not hiring in any big way, and they don't really have an incentive to yet. Because they have the benefit of bringing a lot of this anemic revenue growth to the bottom line, and so the cycle continues. We're not going to hire, profits grow. We're not going to hire, profits grow. We need to kind of break that cycle.
All right, let's get into some of the earnings that you referenced. Facebook's first quarter, kind of a mixed bag, Andy. Revenue up 38%. That was better than expected, but profit up just under 7%. They missed there, and yet it seemed like from an expectation standpoint, people were pleased. Shares were up 5-6% on Thursday.
Yeah, I mean, Chris, I was looking for the mobile numbers, looking to make sure we're continuing to see mobile ad revenue growth, and we are seeing that is now more than 30% of total advertising revenue. That's up from the previous quarter of 23%, which is up from 14%. So we are seeing some, accelerations here. The key is just growth, continuing to see growth in both usage and how are they monetizing this base? How is that ad revenue going to continue to grow? How are they using graph search? How are they using the platform to be able to grow and monetize off now more than 1.1 billion users around the world who use Facebook and will continue to use it? How are they going to profit off that growth?
And while it wasn't all wine and roses, Jason.
Roses.
When you look at the mobile number, I mean, this is a business for Facebook that basically didn't exist a year ago.
No, you're right. It did. I mean, I applaud them for making that move because it's a necessary one. And I think really the big bet that they're placing is on this Facebook Home dynamic, the app that essentially takes over your smartphone. If they can pull that off, if they reel people in there to really create and develop that engagement factor, then I think they have a good shot at really developing a long-term monetizable model. If this doesn't work out for them, though, I think that'll be a big hit, and really who knows what can go there. But the price today certainly still reflects a lot of optimism.
You know, Chris, one thing that they talked about is just the expense line. The expense line continues to grow as they make these investments, and that has an impact on margins. And really, ultimately, it comes down to profits, Ron. And you start looking at a company like Facebook, they have to continue to grow the top line. Also, investors have to see that go to the bottom line to get really excited. And I think when they look out in the near term and those operating expenses continue to grow, that is one factor that investors may be worried about.
LinkedIn down 10% Friday morning after first quarter earnings. Help me out here, Jason. Revenue nearly doubled. Profit more than quadrupled. Why the drop?
Well, so ultimately the 10-second takeaway here for investors is that they need to be looking at today's drop as really, I think, an opportunity to buy into an excellent company. These guys are still really, they're firing on all cylinders is the only way I can really put it. And if you look at it today, 225 million registered users. Yeah, I didn't mean to take Ron's line.
I was going to say, I think
I get a royalty every time it goes out, so we're good.
Credit you for it. But no, I mean, 225 million registered users now. Engagement continues to improve. They have more than 18,000 corporate clients now, and they just passed through a price increase. So going through the call, the big concern, I think, was, they make their revenue from three different main buckets: in marketing, premium subscriptions, and talent. Now, marketing is the one that kind of falls in the middle there, and they're sort of revamping and adjusting their marketing strategy to bring more mobile into play there, and they saw a slight tick down in that marketing revenue. I think that tick down probably had some people jumping ship today, and that's the big problem there. But really, the long-term picture is it remains. These guys are really doing well.
Yeah, I think Jason's right about the tick down there, but also they said they were going to be spending more because, quite frankly, they're still a relatively young company. They need to spend to scale this business, and I just think there are the wrong investors in this stock right now. If you're selling this stock off in a significant way to the tune of 9 or 10% based on this earnings report,
right,
well, you shouldn't have owned the stock in the first place. It's not a value investment. You can't be looking at quarterly beats and 1 cent here, 2 cents there. This is a long-term play, and the company's doing fantastic.
When you step back and you look at these social media stocks, LinkedIn, Facebook, even Yelp, which earlier this week, and obviously it's a much smaller player. I think the market cap's around $2 billion, but Yelp was up 25% this week based off of their earnings. In Yelp and Facebook, it's very much an ad model. In LinkedIn, it's very much a membership model. Is membership automatically that much better? Or, I mean, how do you guys think about the two models just as they stack up, as they relate to these stocks?
I think a lot of it is an expectations game. I mean, Yelp, certainly the expectations were very low, and when they brought in that actual top-line revenue growth, that's what encouraged the market. But that's one of my holdbacks on something like a Facebook or a Yelp. One of the things that gives me caution there is the fact that they're so based on advertising. You see kind of where Google is nowadays. Google makes a lot of their money from advertising, 95% or so. They've really done a great job in sort of shaping that online advertising environment over the past decade. Facebook and Yelp are still relatively new to that game and have a lot to prove. So that's where I look at something like a LinkedIn. That's why it's so much more attractive, because they make their money from a number of different ways, and advertising is just really a small part of it.
Yeah, in general, I like membership better because I think it aligns the company with its customers in a much more significant way versus the advertising model where your end user you're really not aligned with in any significant way. So membership, recurring, sticky, I like it much better.
All right, shares of Visa up this week after strong second quarter earnings. The company also raised guidance. Ron, that's always a nice duo right there.
Yeah, the company did really well. If you take out some adjustments for some tax benefits, profits were up 17%. Beat expectations, raised guidance, as you said. So firing on all cylinders. That's the second royalty I get. Can I pay myself?
Yeah, sure.
I think the company is doing great. I mean, it's a large company at this point. We're pushing 180 115 billion market cap. So I don't think it's necessarily cheap, but I do think that they're putting up great numbers.
Okay, so the Pepsi to Visa's Coke is, of course, MasterCard also reporting this week. First quarter profit up 12%, but Andy, they missed on revenue. The stock rebounded later in the week, but when you look at MasterCard, what do you see?
Yeah, well, as Ron said, the same thing with Visa. These are just beautiful businesses. They have deep moats. They have high recurring revenue streams. They have exceptional margins. I mean, MasterCard's operating profit margins are almost exceeding 50%. The returns on capital extremely high. So these are great businesses. I mean, their EPS line for MasterCard was still up 17%, ex some currency factors. That's right in line with what they expect to do over the next 3 to 4 years. So I don't let the short-term, quarterly, gyrations affect my decision with a company like MasterCard. Interesting enough, it is a $65 billion company, about the same as Facebook. They do about the same amount in revenues, yet MasterCard generates far more profit. So on a profitability standpoint and a multiple standpoint, MasterCard looks much more reasonable, even though still at 20 times profits, 20 times earnings, it's a little bit on the higher side. But for the business and the quality of the business, it's hard to beat a company like MasterCard.
Both MasterCard and Visa shares hitting all-time highs this week. From a valuation standpoint, Ron, how's Visa looking? Little frothy.
Little frothy. MasterCard edges it out just a bit at 4 times cash flow EBITDA, 16 times for Visa. So MasterCard's just a tiny bit cheaper.
Okay, do I get royalties for frothy? I
No.
mean, if we're talking royalties here, let's get this out on the table.
Coming up, just because the critics don't love it doesn't mean a movie can't make an insane amount of money. The latest example is next. This is Motley Fool Money. Welcome back to Motley Fool Money. Chris Hill here in studio with Jason Moser, Andy Cross, and Ron Gross. DreamWorks Animation first quarter profit fell 39%, but investors were expecting a loss, and shares up this week around 10%. A lot of the credit for the quarter went to The Croods, an animated movie about a prehistoric family. The reviews were so-so, and families, Jason, still went in droves. I had to double
Would
check.
you say they flocked?
I had to double check this number because I didn't believe it the first time I read it. The worldwide gross receipts for this film, $480 million.
Wow.
Yeah, you got to really give them a round of applause for that, because I mean that's the expectations for these guys going into this quarter were extremely minimal, and so to bring in $5 or $6 million in net income was obviously a big win for them. With that said, I think there is a correlation here, mind you, as to when The Croods was released, because as we've noted, there wasn't anything else out there.
Right.
I mean, you either stay at home or you take your kids to this movie.
That is
now,
a strategy and an art to
after
time a film.
I'm going to throw Mac under the bus here. After his review of this movie, I chose not to take my kids to the movie, and we stayed at home. And so maybe we'll catch it. Maybe we'll catch it on demand or something like that. But I do think that they face a greater headwind in something like a Walt Disney that continues to just churn out hit after hit after hit. They're sitting on their next billion-dollar movie here with Iron Man 3. And so with DreamWorks, it is to me a classic value investment. When you see the stock reaching highs like it is today after a hit like The Croods, I think that's when investors probably need to be looking at selling this stock and wait for them to kind of come back down, because they will. And then you can maybe look at buying it again. It's not one that I would recommend holding on to for a long period of time.
Ron, to Jason's point, Disney shares hit a new all-time high this week. Last weekend, Iron Man 3 opened overseas, took in $195 million. This weekend, it opens in the U.S., China, Russia, Germany. It really does seem like they're just going to be printing money on this one.
Disney's a wonderful company, and they do so well in all of their segments, especially the ESPN that we speak about often. This is one of those stocks I sold too early on valuation. Not the first time I've said that on this show, but I actually my kids still own it, and they're proud shareholders, and I expect we will be for quite some time.
Yeah, to put that just into perspective too, you remember so if Iron Man 3 is another billion-dollar movie, well, their studio segment is responsible for only about 7% of their operating income, Walt Disney's operating income, and I think that just shows you how this company makes their money so many different ways, and in relation to how profitable they really can be.
Interesting that DreamWorks is less than $2 billion in market cap, and I think the price that Disney paid for Pixar was more than $6 billion. How many years ago? More than 10 years ago. So just the relative value that DreamWorks has right now, and the relative value that Disney paid for Pixar, and the value that Pixar has created over the years for Disney and for the franchise, and will continue to generate for many years to come.
Shares of Buffalo Wild Wings down this week. First quarter earnings fell 11%, much worse than expected. And yet, Andy, the company still bullish on the full year, maintaining their guidance. What'd you think?
Yeah, I think it was still a really good quarter. I mean, we talked about this a little bit on Investor Beat. You know, it's interesting because the thing I love about Buffalo Wild Wings is just the management team they have in place.
Sally Smith.
Yeah, Sally Smith, Mary Twine. I mean, they just have been there for so many years. They're reinvesting back in the business. They have faced some higher chicken wing prices. That's starting to mitigate a little bit throughout the quarter, but they certainly saw that last quarter. They are going to this new pricing schedule based on the pounds, not based on the number of wings you actually get. So the confidence I have in Sally and Mary to be able to navigate those kind of environments, they've been through this before. They are reinvesting back in the customer experience, really trying to grow the store base, do it right. That having that track record really helps when you kind of face these headwinds. And I own the stock personally, and I still like it long term.
Let's stick with restaurants, because last week Bob Thompson, the CEO of McDonald's, said in an interview that McDonald's is very seriously considering moving to serving breakfast all day. And Ron, when you consider they've got locations that are open 24 hours, this seems like, to me anyway, this could be a significant win for them. What do you think?
It's an interesting move. They have to do something. They've had 3 consecutive quarters of declining profits, and they really have to kind of shake it off a bit and come up with something new. Rising commodity costs are hard to, when you have a dollar value menu, it's hard to make money when you have commodity costs rising. So they've got to do something. My gut tells me it's not the right thing for them in terms of hurting their kitchen efficiency, the spoilage that will occur. I don't think the demand will be there to offset the costs, but I think we'll watch it and we'll see what happens.
I got to give a shout out to our colleague Charlie Travers, who flagged a really great article in Fast Company magazine about Taco Bell. It was a long article basically giving the backstory on the Doritos Locos Taco, which for all the fun we had talking about that product and just the whole notion of a Doritos taco shell, here are a couple of numbers to mull over. In the first year, they sold around 450 million of these tacos. And here's a direct quote from Taco Bell CEO Greg Creed. "We had to hire about 15,000 people last year, which is 2 or 3 per restaurant, to handle the sales growth and demand of the Doritos Locos taco business." That's staggering that it would have that kind of ripple effect. And when we look at restaurants and how they're trying to pull different levers, it's just amazing to me that a significant move like serving breakfast all day, by your way of thinking, Ron, that's going to do it. But in this case, here's one. Yeah. It's not even one new product. It's one new shell. And it's a new taco shell.
And it wasn't a little bet. It was, there was some costs associated here. And they actually didn't even have a contract. It was kind of a handshake. Taco Bell said, we're going to spend some money. The Doritos folks said, we're going to spend some money and we're going to get this done. So it was really interesting that it all worked out for them, because it wasn't a cheap undertaking.
They have marketed the heck out of this thing too. I mean, you could just turn on the TV at any given time and you see a commercial, pushing these things. So they've really, really created awareness for them.
I mean, the thing about these stores that in a world of U.S. growth, which is, I mean, I know they're global companies, but in U.S. growth where you're at 2 to 3%, you are definitely pulling levers and making investments and not inconsequential bets to basically try to encourage more customers to come into your stores, order products that have higher margins and make a higher return on the investment that you've earned to be able to continue to meet investor expectations. So we're seeing this with things like Taco Bell, KFC's. I talked about this before. KFC's I Eat the Bones concept, and how much marketing is going into there. So these are continued examples of large companies making mostly innovative changes to their menu to basically try to juice more and more customers that come into the stores.
All right, Ron Gross, Andy Cross, Jason Moser. Guys, we'll see you later in the show. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. I'm Chris Hill. Joining me in studio once again, Jason Moser, Andy Cross, and Ron Gross. Before we get to the stocks on our radar this week, one other story we should get to, which is Kraft. The gigantic Kraft Foods reported earnings this week. But Frankly, I don't care about their earnings. But here's what I do care about.
No one else did.
Exactly, which is one of their brands, one of their many brands, which is Kool-Aid. The Kool-Aid Man. I think we all remember the Kool-Aid Man from growing up.
Oh yeah.
Oh yeah.
Oh, yeah. The Kool-Aid Man mascot first appeared in 1954, and he just got a makeover within the last couple of weeks in TV ads. Now he's like a CGI animated. He now has pants and a jacket
slimmer.
Thank
and
God.
shoes. They slimmed him down, which makes no sense because he's a pitcher. Like, I don't know why he needs to be more athletic. But from a business standpoint, it now comes in a liquid mix.
Yeah, pretty cool.
I was actually happy to see that there's a business rationale. It wasn't just someone walked into a room and said, "Yeah, I think it's time to change the old man." The liquid mix business has been crushing Kool-Aid over the last couple of years.
And the creepy marketing has Mr. Kool-Aid Man opening up his closet to see all the different flavors to decide what he wants to wear that day. He gives himself a little squirt, and that's what his outfit
So it's
is
just
for the day.
wait. I haven't seen this yet. So he's just like clear water, and then he's pouring a little.
Yeah, exactly. And so he goes out, cherry or grape or whatever he feels for the day.
Steve, what do you think of this? I know you're just hearing this for the first time. What do you think? Is this going to succeed for Kraft? Is this rebranding of Kool-Aid? Do you think it's going to help them?
I have no idea. I do drink a lot of Mio. Do you guys know what Mio is? Mio is I think they invented, I believe they did, this liquid kind of concentrated thing, and I drink it all the time.
That's a Kraft product.
All right, well then I'm all for it. Bring it on,
I
Kool-Aid
like how he
Man.
said, I have no idea when you asked. I'm going to start using that.
In all seriousness, a couple of years ago, we were talking about Tang and how Tang was this just moribund,
I think I know where you're going.
languishing product, and they were able to just significantly ramp up sales. Annual sales for Kool-Aid, $338 million. Is this the next billion-dollar brand for Kraft? What do you think, Ron?
Oh, gosh. I'm going to take the Steve tact and say I have no idea. I think not. No, I think it'll be a nice incremental business, but I don't think it's a billion-dollar business.
I'm rooting for him. How can you not?
And we
root
should
for the
encourage
Kool-Aid?
users to send us different flavors so we could try it out, as they did with Tang. They were very kind.
Absolutely. We had people sending us Tang from literally around the world. So, yeah, and I haven't seen this new liquid mix product, so by all means, if you want to, just put some in a little package, send it off to Fool Global headquarters in Alexandria, Virginia. We love product. We're always fans of product. Let's get to the stocks on our radar. Ron Gross, you're up first. And yes, Steve, our man from the other side of the glass, will be hitting you with a question.
Hasn't he spoken enough today?
Yeah.
Well, I've got Activision for you, ATVI. It's a company, after many years of patient ownership, it has finally woken from its slumber. Stock has performed well. They report next week. I definitely want to hear what they have to say about their capital allocation program. Dividends, share buybacks, acquisitions, $4 billion of cash, no debt. Very important to the thesis here. And, of course, I want to check up on their franchises and see how they're doing.
Steve, question about Activision?
So I've owned and sold Activision. It's been the kind of stock that the Call of Duty 4 will come out, and it's this blockbuster thing, and you hear in the news, it made more money today than every movie in history combined, and the stock continued to go nowhere or go down. What is wrong with this company?
Well, you might be exaggerating a bit there, but yes, I understand your point. And that's why I did lead with the fact that finally it's woken up. We never understood why it didn't. They kept putting up better and better numbers each year. Nobody seemed to care. It is a tough model, kind of like the movie model. You constantly have to reinvent, the next game, the next big thing. But finally it has woken up and it started to do well for us.
I like that Steve's question was essentially, what the hell?
You're blaming me.
What about me?
Andy Cross, your stock this week.
Whole Foods reports and symbol WFM, the large organic grocer with 300 stores and one right down the street where I know most of us spend a lot of our lunchtime. I'm looking for gross margin. I mean, for grocers that are not typically very profitable. I mean, operating profits run in the low single digits, except for Whole Foods is on the higher side. So gross margin is really important. Second quarter of last year was an all-time record for them, more than 36%. They're not expecting much better than that, but I want to see how that is impacting or how they are doing on the gross margin side, because it gets to the fact of how much people are willing to pay for the higher prices at Whole Foods.
Steve?
Can Whole Foods ever be more than a grocery store?
It's a good question. So, like, whether they're getting into different areas like catering, perhaps, like that's a big part of the Whole Foods store. I mean, 300 stores, they have some room to run here with smaller concepts, smaller store bases, and more products. I mean, they've moved more and more into, even down here locally, Steve, with our Alexandria store. on the outside of the store aisles, moving to more packaged good, moving to more prepared foods. They have a bar now down in our Alexandria store. So I think they do have these concepts inside the whole grocer, but it's a conscious capitalism business. John Mackey founded it. He's running the show, and it will continue to do well if he continues to work on the things that got him there.
You had me at bar.
Yeah.
We got less than a minute left, Jason. What do you got?
Clean Harbors, ticker CLH. And these guys operate in the exciting business of hazmat, environmental cleanups, chemical cleaning, things like that. So it's still a small business, about $3.5 billion company. They have clocked in revenue growth, about 27% annually over the last 3 years. So they're growing quickly. But I like the business basically because they do a lot of stuff that a lot of other people can't do. This industry has very high barriers to entry as far as economically speaking, regulations. So interesting company. They diverse revenue stream. The big segment for them is their technical services segment, and I think the stock today at 20 times estimates is a good deal.
Steve?
Are you betting on bad things to happen with this company?
No, I'm actually betting on a giant Kool-Aid spill, and I think that's going to be a real impetus to grow within the business.
Oh, yeah.
That'll do it. Jason Moser, Andy Cross, Ron Gross. Guys, thanks for being here.
Thank you.
Thanks, Chris.
That's going to do it for this edition of Motley Fool Money. Our engineer is Steve Broido. Our producer is Matt Greer. I'm Chris Hill. Thanks for listening. We'll see you next week.